Good afternoon, everybody, and welcome to our 4:30 p.m. Eastern Time closing bell webinar. For those of you that do not know me, my name is Josh Levitan, one of the day trading instructors here with Cyber Trading University. Let me just get a quick sound check so I know that you guys can hear us loud and clear. Perfect. Everybody coming in right now. Richard, Basil, Neer, Jeff, Ali, Lynette, William, Jacob, everyone else coming on in. Where's the gong? Ron says, that's a cyber group feature only there, Ron. Today, I didn't want to scare everyone else coming on in because we have a fantastic guest for us today. We have a good friend of ours here with Cyber Trading University, so give him a good on welcome to Alan Knuckman from Bullseye Option. So, you guys may have seen Alan. He's been all across TV. He's been on CNBC, Bloomberg, Fox Business, CNN, practically everywhere. What Alan is presenting to us today is understanding the 70% probability plays using market fear factor. So obviously, through our students here in Cyber Trading University, you guys see through the intraday market, understanding high percentage trades, the amount of buying and selling, but obviously using that buying and selling can cause a lot of fear, can cause a lot of commotion, and from there you have a lot of traders making uneducated decisions. So what Alan will be showing you today is essentially how to capitalize on market fears and how to capitalize on emotion in terms of the swing trading, in terms of the technical analysis, because that's Alan's specialty. He's been in the market for about 25 years. He's been an options expert. He's been a technical analyst. So that's exactly what he'll be going over today. Alan, are you there?
Josh, yes, sir. Yes, sir. I'm ready. I'm ready to go. Thank you for the kind words.
No problem at all. The floor is all yours.
All right. All right. Thanks, folks. I appreciate the audience. You understand the importance of putting the odds on your side. That's what we're going to talk about today. And I want to hopefully give you a little bit of an attitude adjustment as well. I know a lot of people, not you folks necessarily, but a lot of people are a little bit negative about markets, negative about what's been happening, even though we've had an extreme comeback rally. We've seen this before. I'll talk about that in a second. But thank you for the introduction, Josh. Hopefully, I am an old-time trader, but hopefully I don't look like an old grizzled trader. I've been around for a long time, seen all the markets, currencies, futures, options, um, and stock, obviously. And what I'll talk about is the discipline to make money. It's not so much what you trade, but it's how you trade, as you well know. By having that extreme discipline, being an active participant. I'm going to show you a different way to look at the market. I'm going to have a couple of things to look at here today. First off, I'm going to show you how to use options, not stock. But like I said, a lot of this is about attitude adjustment, putting the right frame of mind that there's opportunity. We're going to talk about controlling probability, which you're familiar with right now, and how to fit your lifestyle in addition to the active trades that you do. Because there are some days where you have the ability to do your active trades and other days where you don't have the time and energy to focus on the market. So these are some lifestyle trades that you can employ and not have to worry about the day-to-day market action as things move around. So let's talk about that. This fear factor is very important right now. This is the best time in history. People are paralyzed by fear. It's gotten so that people are missing out on amazing opportunities. They don't get it. They're paralyzed by fear, too worried about what could happen. Instead of taking advantage of what does happen. This is the best time in history for an individual trader. As you well know, electronic access gives you access to markets any direction, anytime, any market. I had dabbled in the treasury bond pits in Chicago, and if the markets weren't moving, you couldn't just step over into soybeans or step over to gold and start trading those markets. Everybody had their territory. So now you have opportunities, any market, anytime, just look at a screen, whatever's moving, you can take advantage of it, any stock, any currency, any futures contract, so forth. Also, what's really important is commissions are very, very low. No one likes to pay commissions, but think about what commissions do. They make you think and make you have a discipline to attack the markets. It's very important. But what's really more important than the cost is these tight bid-ask spreads. You can get in and out of your trades very efficiently. When you want to buy, there's plenty of people who want to sell. When you want to sell, there's plenty of people who want to buy. So that's very, very important. In your execution of your trading plan. So you can execute your discipline, you can plan your trade, and you can trade your plan because it's all about risk control. Risk control is the focus. That's the difference between a novice trader or a professional trader is controlling risk. A professional focuses on what's my risk, what's my worst case scenario. If this doesn't go my way, where do I stand? And so it's all about a string of long-term high probability events to be here for next week, next month, next quarter, next year, next decade. So controlling risk is the focus. So I want you to walk away today with a newfound optimism about the opportunities the markets have. Their markets aren't good, markets aren't bad. They just are. There's always opportunity. Markets can be going up, markets can be going down, they can be going sideways. It's about putting probability and opportunity in your favor and having the tools and the skills to do that. So let's look at where we've been. And this chart only goes back a year, but this is the S&P, the broad market in general. As we know, that's the stock market. The Dow is only 30 stocks, and it's weighted by share price, not capitalization. The Nasdaq's the Nasdaq, and actually the Nasdaq never is still not positive. It's about 5% away from positive 2016. So it's lagging very, very much behind. Whereas last year it had led the way. But if you look at the S&P, we've had three major breaks in the last year and a half or so. If you go back to October of 2014, then you go back to August of 2015, and then you go back to January, February of 2016. Each and every time the market's recovered. What I see here is the fundamentals didn't change. We had some disappointment when we couldn't make new highs. The fundamentals still remain solid. We've got low interest rates, we've got low energy prices, and we've got record earnings. The only thing that's changed is the earnings strength has slowed. So there's actually been a decline in earnings, but we still make, these corporations are still making an absolute ton of money. They made a trillion dollars in profit. The S&P companies made $1 trillion in profit in 2015. So it's not like these guys have forgotten how to make money. They're just not making it at the same exponential rate that they were. So when it comes down to it, think about it. Money has to go somewhere. The U.S. stock market is the investment area of choice. Corporations are doing very well. The interest rate environment, the environment for companies are still doing fantastic. And let's not confuse the economy with the stock market. Two very, very different things. Companies are doing very, very well. Money has to go somewhere, and right now the American stock market is the place, the choice for yield. Look at all the countries around the world that have negative interest rates. You know, the S&P 500, if you just look at the dividend yield of the S&P 500, is about 2.5%. That beats the 10-year note. So right now, with interest rates extremely low, you know, and yes, they're going to raise rates. Might happen next year, might happen the year after, who knows? But we're still at extremely low levels. Those are all very positive for stocks. So what does that mean to me? Well, that means there's still huge opportunities in the stock market. I'm not the guy that's going to call the top in the market. Each and every time the market's sold off, it's bounced back. Okay, it's going to do so until it doesn't. You have to respect the resiliency of the market. And this last 15% move off that double bottom low that we saw in the S&P was amazing, an amazing bounce, and there was an amazing capitulation where we saw the market take out those last lows and then bounce right back. But what's interesting, I'll talk about that, is volatility did not make new highs, even though the stock market made new lows. So that was an indication that the sellers did not have control like they had before. They were a bit tired, a bit exhausted. I look at the VIX just to give me a gauge of the market, where that fear level is, so I can use the appropriate strategies for the market. And looking at this, you can see that the VIX has traded mostly between 20 and 12 over the last year, actually the last 5 years. So overall, the trend in stocks is up. Overall, the trend in the VIX is down. So each and every time the VIX pops up, it gets beaten down just like the whack-a-mole that you see kids play at the Chuck E. Cheese. It pops up and gets beaten back down. So it's important now we're within that range, and we're right at the middle point of that range. 16 is the middle of that 20 to 12 range. Let's remember, only 2 weeks ago we were at 1250. So just because volatility is low doesn't mean it can't go a lot lower. But what that does is help me determine what strategies I want to use for the marketplace, because it's all about probability for me. It's all about probability. I tell people, don't watch TV. Turn off the TV, even though I'm on hopefully every day, a couple times a day, different networks. I do things a little bit differently. I go on with something specific to look at, a specific opportunity, where to get in, where to get out. You got to understand that CNBC, Bloomberg, these guys aren't there to help you make money. They're in the infotainment business. They're in the business to make you emotional, get you wound up, get you off your discipline, get you off your game, so you start overthinking your trades and not executing your trading plan. I hopefully do things a little bit differently. I want to go in there and talk about something specific I'm looking at. You can investigate it, look at it, and decide if it's something warranting your time, money, and attention. But like I said, I've been around these markets a long time. I tell you to turn off the TV. Watching 8 hours of CNBC a day is not going to help anybody make money, and a lot of times it does you a disservice, not actually helps you profit. The key that I want to talk about today is how to profit right now in this market environment. I'm going to show you two great examples of how to do that. Stay to land in the presentation. I'll show you how people were completely right with catching that market bottom that we had there in February and March, but still ended up losing money. I'll show you a little trick to avoid that, and it's just so disheartening that people didn't take advantage of it. What I want you to take advantage of and understand how to take advantage of is time. Time is your greatest asset. Think of Warren Buffett. The reason Warren Buffett is so successful, you got to equate it to the infinite amount of monkeys with an infinite amount of time. They're going to type a novel. Well, think about it. Warren Buffett has an infinite amount of money and an infinite amount of time. The market is not going to force him to get out of his position. So he's going to be successful. He's looking at positions for the long term. He's going to be there until he's right. And it's a strange phenomenon, but markets, when they force you to make a decision and exit your position, you usually do so at the exactly wrong time. A lot of times you're a buyer when you should be a seller, and a seller when you should be a buyer. And I'll show you an example of that as well. But I want to show you today how to use time and probability. If you can control those two components, you're going to be successful. That's the difference. Control time, take time out of the equation. I'm going to show you how to do that so that you won't have the Warren Buffett infinite amount of time and infinite amount of money, but you'll be able to maximize time and give yourself enough time to be right. And the key for me is probability. I only want to trade positions that have a 70% probability or greater. 70% probability. If it's not 70%, I don't want to mess with it. You know, buyer selling a stock, you've got a 50-50 chance. Hopefully, whatever techniques you're using will increase your probability, but you've got a 50% chance it's going to go up, 50% chance it's going to go down. I can choose my probability, and I'm going to show you the secret of how to do that. You can choose 70, 75, 80%. At this point in my life and my career, I don't want to gamble. I don't want to take long shots. I want to trade probability, and you should too. Make your life that much easier. Visualize sitting back, letting the markets do the work for you. Don't work for the markets. You work. Let the markets work for you. Choose only 70, 75% probability plays. It's a very simple methodology. Trading is not hard. Trading is easy. Managing yourself, your discipline, and your personality, that's a little bit different. But you have to have a very basic methodology and an approach for each and every trade so you can look at things objectively. You need to know your cost, your capital requirements, obviously, how much you're going to risk, what your reward is, what your probability is, and where your break even is. If you can evaluate each and every position like that, then you can make informed decisions, objective decisions about whether that trade, that opportunity is right for you. And let's remember, things are so much different than they were when I was younger. When I was younger, if you missed an opportunity, you kicked yourself for days because it wasn't, you don't get them every single day. Whereas in the marketplace now, there are countless opportunities, long, short, sideways, stocks, options, futures. There are plenty of opportunities now. So you have to have the discipline to only trade the best of the best and step aside and let the other ones go. That requires some work on our part to be able to do that. I use options because options will allow me to control these variables that I want to. Now, smart people have some misconceptions and are intimidated by options. Smart people have a couple things wrong about options. So let me just get into the basics of options. Now, I use options simply as a vehicle. I'm not trying to be the smart guy, trying to outsmart the Morgan Stanley or the Goldman Sachs guys with their trading strategies. With their trading strategies. Um, so what I'm trying to do is take advantage of probability. So options are not complicated. The market can only do three things. It can only go up, down, or nowhere. So that's all it can do. You're going to put on the appropriate option strategy and a very simplistic approach. I make options ridiculously simple. You're just using the right strategy for the right market conditions. A lot of people think options are a gamble. The idea is to put odds in your favor. Let's not look at these 5 or 10% long shot plays. Unfortunately, that's where most people start. Novice options traders buy cheap, out of the money options because they're cheap. They have a low chance of being successful. So they're buying what we call lottery tickets here in the business in Chicago. Whereas, you want to buy the high probability positions. The new traders buy these $100 options or $50 options. That the reason they're cheap is because they have little chance of being successful. Either they have very little time, or they're very far. The probability of success is very, very small. Put the odds in your favor. That's what we want to do, and that's what you're able to do with options. I'm going to show you a real easy trick to do that to be able to go and attack the market. So the number three is time. You want to use time in your favor, like I talked about Warren Buffett. Let's maximize the time, and I'll show you a little trick to do so. If we can go right now, let me try and go to the screen sharing, and I wanted to show you some recent examples of. Let me just click on the monitor here. Some recent examples in my Inner Circle membership service, and there we go. And if we go to my bullseye option service, we just exited a position in silver. Now, silver is an interesting, let me find a trade alert here. Silver's an interesting play here recently, in the fact that it had an amazing technical formation, and let's see here. Here's a trade alert for bullseye options using silver. So this is an example of buying enough time to be right. Now, silver had a nice pattern, a nice formation, and you can see here, you can see this nice saucer bottom that we had with this cup and handle, and that targeted 17, and actually it just got to 17 yesterday. So it was a textbook trade. That's what I'm showing you. I'll show you a loser as well, but there's a way to mitigate the losers as far as the probability goes. So what I wanted to show you was that this this option that we had purchased was a July option that we put on in March. So it had plenty of time to be right. That's the idea: is buy more time than you need, have enough time to be right. So buying an in-the-money call, I use my stock substitution strategy where I'm buying an in-the-money call to act much like the stock, and I'm trying to take a look and see how many days this had until expiration. But it was a July option, so it had over 3 months. So even though I was expecting a short-term move and it happened in 6 weeks in silver, I had more time than I needed. So if I think something's going to happen in a couple months, I'm going to buy 4 months. If I think something's going to happen in 6 months, I'm going to buy a year of time. So the idea is to buy more time than you need. So you're taking time out of the equation. And right now, with volatility relatively low in historical terms, options are cheaper now than they were last year or the year before that or the year before that or the year before that. So the in-the-money call, and I'll show you a couple little tricks here. The in-the-money 13 call had a delta of about 80%. Now what that means, that's the only Greek I'm going to get into today. I want to make things very, very simple. It had a delta of 81%. Now what that means is it's going to act much like the stock. So for every dollar the stock goes up, that option will gain 81 cents. All right, so it's going to act much like the stock. A deep in the money call. The market was trading at, where were we at here? It's trading at 15 or so, 14 and change, and I was buying a 13 call. So I had the right to buy down at the lowest level, down near the lowest level, or the lowest level it had been all year. So I had paid $2 for that particular option. So it was, the break even on that was about 30 or 40 cents away. Very reasonable. So all I'm asking is I'm asking silver to go up 30 or 40 cents in the period of a little bit of 4 months. A very reasonable expectation. But the power of options allows this to profit significantly only on a modest move in the stock. So that's the idea behind the stock substitution strategy. But that 81% delta also means something else that you want to be aware of. It also approximates the probability that that option will be in the money at expiration. So who would want to buy an out of the money option with a delta of 5 or 10 or 15% compared to an in the money option that's going to have a delta of 80%? The 80% probability puts the odds on your side. So I had more time than I needed, and I didn't use it, but I had that luxury if I needed to. So I put time in my favor. Now, a lot of my options friends are very sophisticated, doing complex multi-leg strategies. They kind of scoff at this approach. I'm using options as the vehicle. I still have to, have an understanding of whether I think the market's going up, down, or nowhere. And I'm using options to take advantage of time and probability. That's the difference. That's the difference, and that was an example in silver. Now, here's an example. XLF got a 50% return, and that silver actually had a 100% return. This underlying silver market moved, I think maybe 10 or 15%, but the option gained 100%. That's the power of these in-the-money options. You can do calls or puts, either side. You're using an option instead of buying or selling the stock. Here's a quick example in XLF. XLF, I purchased 1 year and 4 months, bought a January of a year and a half out option, looking for the market to have a modest move. The break even on this was about 50 cents higher in a year and a half. Again, the idea is to profit if there's only a very, very modest move in the underlying stock. If there's a huge move, great, everybody makes money. But I still want to be able to make significant amount of money in the power of options buying those in-the-money calls. I'm going to get a great return and just a modest move of the underlying. So you could see XLF moved and the option gained 50%. And if you look at the chart, we had a very reasonable move in the underlying from here to here and still had 3 months left of time. So you take the time out of the equation, buy more time than you need, buy those in the money options, those in the money calls in this example. So the option gained 50%, whereas the underlying had about a 10% move. Now 10% is great. 10% is fantastic. You can't complain about 10%, but you get that multiplier of buying the option. Now, when you buy an option, your risk is limited to what you pay, which is very important. If you're an option buyer, you've got built-in risk control. What you pay, that's your maximum risk. So if you pay $225, $425 for that XLF option or $200 for that silver option, that's your maximum risk no matter what happens. Now, I recommend that people put in a stop loss at half of what you pay because either if an option loses half its value, either you're running out of time or the market's moving the other way. So someone asks you buy a delta of 80% or higher. I'm buying an option and I want to make sure it's 70%. I want to have the delta of 70% or higher, and I want to make sure that I'm going to have I want to have at least 3 months of time. 3 months of time are minimum. Those are my thresholds. But I wanted to get into this other myth that people think options are risky. No market is any more risky than any other market. If you don't have discipline, it doesn't matter whether you're trading currencies or futures or options or stock. It's not the market that's going to get you. It's your lack of discipline. It's your lack of plan. It's your lack of risk control. Options have risk control built in, knowing that if you're an option buyer, they can only go to zero. Some people think that options management takes too much time, and that's one of the secrets I'm here to show you today, is how to use these in your lifestyle. If you're looking at something 6 months out, 8 months out, a year and 4 months out, you're not worried about the day-to-day fluctuations. You're worried about what happens on a weekly, maybe even a monthly basis in the big picture. You have a wider window of opportunity. You're able to have this fit your lifestyle, not be chained to your computer, not have to worry about every uptick and downtick in the marketplace, not worry about all the news, the nonsense, the interest rates, the Brexit, whatever the crisis du jour is. What was today? Today was, believe it or not, the euro currency got too strong and the dollar got too weak. Well, geez, I guess it was just the opposite a couple years ago. So I don't know which one it is. People are always looking for reasons to be fearful of the market, and the market need an excuse to take profits, and really that's what happens. So what I like to do is, at this point in my life, I'm actually waiting to pick up my daughter to take her to softball practice. My lifestyle has changed. I don't want to be an active trader anymore. That's great if you've got the time and the skill and the discipline to do that. That's great, but it requires a lot of discipline. And right now, I still want to be able to take advantage of the markets, and I do this in addition to those days where maybe I can sit there for a couple hours focused on the active market. So look at this as a way to complement what you do with your active trading. These can fit your lifestyle. You can use options to fit your lifestyle. Look big picture. So let me talk about a couple of strategies today. I'm going to look at we're going to look at some strategies to take advantage of two scenarios. The scenario where you have high volatility and the scenario where the volatility is not. So first off, I had shown you the stock substitution strategy. That's more of a low volatility strategy, and the trick of buying the in-the-money option actually eliminates that time component, and so you're taking volatility out of the equation because what you're buying is mainly all intrinsic value. So the volatility really doesn't impact the price. I'll show you that in a minute. But what I want to show you today is my option wheel strategy. This is a great strategy when markets are coming unglued, and there's a great satisfaction in making money when everybody else is fearful and can't figure out what to do with the markets. So my option wheel strategy is a way to get small returns on a monthly basis, but on a regular high probability monthly basis, in addition to your regular trades, your directional trades, to get some revenue each and every month. The idea is to get 5% return on a monthly basis. Now someone's going to say, well, 5%, that's not a huge return. Well, if you annualize that, that really adds up. Multiply by 5 by 12, that's a big deal. So the idea is to do that because options expire every month. This when the May options expire here the 20th of May, the third Friday. Once those May options go off the board, then you're going to be looking at June options, and then July, and then August, and so forth. So what we're going to do is take advantage of what's happening, like those lottery tickets I talked about a few minutes ago, where novice traders buy these front month options that have very low chance of making money. So what we want to do is we want to use that strategy. We want to be the option seller, but in a very controlled way to generate premium with a high degree of probability. Let me show you the secrets of doing that. So small monthly returns add up. The idea here is to do this to complement your other stuff, not to supplement it, and to think about the rule of 72. The rule of 72 is this. You take 72 divided by your annualized return. That tells you how long it takes your account to double. So you can get an 8% return. All right, that's about the average for the market in the last 40 years, I guess, right? How long would it take? Your account would double. 72 divided by 8 is 9. So your account would double in 9 years. Well, if you can get a nice, healthier return than that, think of how quickly your account would double. These small numbers add up. 5% in 30 days, 7% in 21 days. I'll show you some examples, and it's all about probability. This is a trick that investment managers use to build a portfolio. So we're spinning it on its head, and we're using it for good, not evil. Think about an investment manager. They want to get into a stock. They've got hundreds of million dollars. They want to buy into a stock. They want to buy at a lower price. They have two choices. They can put in a price. They can put in a limit and wait for the market to come to them and wait and wait and wait and wait. Or this trick allows you to buy lower or get paid not to. So here's the genius of it. This was Apple last fall. Apple had been hovering around the 110 level. It was about 15% off the highs. Now, obviously, Apple's been bouncing all around, had some recovery and so forth, and then, had a tough couple 10 days here. But Apple, I want to show you as an example, maybe that a portfolio manager wanted to get in lower. So what they could do is they could sell a cash secured put. Now, I can't stress enough. Cash secured means they have the money in their account. They have the money in their portfolio. They want to buy the stock. All right. They want to buy the stock. So they have the money. But instead of putting in a limit price, instead of saying I want to buy it when it gets down to 102.5, what you could do is sell the 105 put for 250. So your cash basis is 102.5. So either you're going to get into it at a lower level, at a sharp discount. It was trading at 110. So, at a 5 to 10% discount, or you're going to get paid not to. So it's a win-win situation. So if Apple's above the strike price at expiration, then you get to keep that premium. And then you do it again for the next month. In this example, we were selling November, and then you sell December puts. Then you sell January puts. Then you sell February. You keep selling puts to generate premium until you get the stock put to you. If you get it put to you, great. If you don't, you're getting paid. It's a win-win strategy. There's no downside. Now, the downside, Apple's a very expensive stock. All right, so doing it on a $100 stock, that's going to tie up some money. Not everybody has the ability to do so. So what I'm going to show you is how to do this in a lot of stocks. And there are so many of them now that are around the $10 level. You got to think about it. $10 stock, what's its downside? Zero. A lot less risk on a $10 stock or a $7 stock than there is on a $120 stock. So selling cash secured puts on these stocks, something, these reasonable single digit stocks that have been beaten down. Think of all the energy companies, all the commodities, all of the metals, the miners. All of these markets have been beaten down 60% or so in the last year. So there's a lot of single digit stocks. What we're doing is we're taking advantage of high relative volatility. We're using that market fear for good, not evil, because everybody's frightened. Those options have gotten inflated. So what we're doing is we're looking for a controlled way to sell those options to either get into the stock we want at a lower price or get paid not to. So typically lower price stock and high volatility. So let me show you some examples. Let me go into screen sharing here. I'm going to find another example here of recent, and I'll show you how to employ this particular strategy. There's a couple of basic rules for this as well. And so today we're going to talk about two different ways to attack the market. We're going to talk about that stock substitution, and then we're going to talk about, let me get into options here. The option wheel. All right, so the option wheel is something you can do every month. Take 4 or 5 stocks, sell cash secured puts on it. Let's see here. As a way to get into the stocks we want at a lower level. There are plenty of stocks that you like, I'm sure, but didn't go after the bottom. When they were at their bottom, how can we try and pick that bottom? So a way to try and pick that bottom is sell a cash secured put, and then if you get it put to you, great. If you don't, you got the, you're going to get paid. So here's an example. Southwestern Energy, all right, March 21st, sold the April $7 put for 50 cents. So what that means is that you sell the $7 put, you're obligated to be long from $7 if the stock's below that level at expiration, but you're getting paid 50 cents to do that. So your actual basis is 650. So 650 is your basis, and if you look at this mathematically, because it all comes down to math and probability, either I'm buying the stock 17% lower than it was, or I'm getting an 8% return on risk. Either way is a win-win. If you look at the chart, on Southwestern Energy. It traded between, I don't know, 5 and 10 for a good period of time there. And we were selling the $7 put. 650. I'm not afraid to own 100 shares at 650. Each option represents 100 shares, so you'd have $650 tied up. That would be your commitment, okay? And you'd be into Southwest Energy from 650 if it got put to you. And I'll show you a nice little technique with that as well. But it's all about the math. 8% return in a period of a month, or you buy the stock 17% lower. So it's a win-win situation. And if you look at Southwest Energy obviously was much above 650 at expiration there on the third Friday in April. We got to keep that premium. And then we look to do new positions for the month of May. So if we go back now to the month of May, let's look at some of the newer positions that we generated here in the May options. Freeport McMoran, all right. Here's a new trade alert we put on April 5th. So Freeport McMoran selling the $8 put for 50 cents. So the math on that is you'd be long from 750. You're buying it 20% lower, or you're getting paid a 7% return on risk. And the magic of this, to get into the delta, if you look at the delta on the option that we sold, the delta on this option is about 20%, not even, okay? So if you can look, you can see the delta on this is 23%, but our break-even 750, halfway between those two strike prices. So let's say the delta is 20%, means there's a 20% chance it's going to be below that price at expiration, meaning there's an 80% chance it's not going to be below. Odds are on our side. We're counting on time decay because each day there's not a big move to the downside. In Freeport McMoran, a little bit of that time value decays, and we're going to be in great shape at expiration. So we had sold our break even here on this is at 750, and Freeport McMoran I think is at $12 or $11. So still very, very, very far away. We still have a couple weeks left to go. We'll see how it goes, but I'm not afraid to be long Freeport McMoran. Looking at this chart, you can see 8 is kind of this pivot point over the last year. I'm not afraid to be long from 750. And then there's a technique to take advantage of that as well. So I wanted to show you that strategy and get you to understand a little bit of the math behind it. A little bit of the math behind it, because it's all probability. It's all about math. So that's the option. That's the beginning of the cash secured put strategy. The idea is you know where your break even is. If we go back to Sprint here, you know what your maximum gain is. You know what your break even is. You know what your probability is. It's a way to generate high probability profits. That's what the option wheel is. Buy stocks at a discount or get paid not to. Monthly revenue each and every month, 7%, 8%, 9%. If you look, some of the best times to employ the strategy is when the market's completely coming unglued and people are losing their minds. You go back to October 2014, look at these returns, 7%, 10%. Nice healthy returns in a period of 30 days when the market was completely mad. Also happened last October as well. October, we can look here selling the October puts for Freeport McMoran, Sun Edison, U.S. Steel. And the math behind it, either get long the stock 13% lower or get paid 5%. Get long the stock 17% lower or get paid 10%. U.S. Steel 15% lower or get paid 5%. So that's the idea behind it. Even in something like U.S. Steel, there's an amazing technique, and hence the name option wheel, to take advantage of it if it goes the wrong way. If it goes the wrong way, the option wheel has an amazing technique to take advantage of it. So we sold the $13 puts in U.S. Steel for 60 cents. All right, so the break even on that's $12.40. That's our break even at expiration. We're either buying the stock 15% lower or going to get paid 5% return in a month. All right, win-win situation. Either way, I can live with that. I have the money in my account. I want to buy the stock. I want to buy it at a lower level. These are stocks that you want to own, something you can own for weeks, months, maybe even years if you have to. You're committed to it. Just like a covered call, and selling a cash secured put has the same risk profile as a covered call. Just like selling a covered call, you don't sell a covered call on a stock you're not committed to for long term, because the dollar you take in or the $2 you take in isn't going to help you if the stock sells off $5, $10, $20. Now these stocks have limited downside if we're doing an $8 stock, a $10 stock, and so forth. Now in the option wheel, U.S. Steel went completely the wrong way. Completely, absolutely, positively wrong. This strategy profits if the stock moves up, the stock moves sideways, or even if the stock moves down. In this example, it went down to our break-even point was 15% low. Now, what happened is the stock sold off 15% in a month. An amazing, huge move. Wrong. That's not what we wanted. But guess what? We were still above our break-even. On that Friday at expiration, our break-even was 12.40. The market was at 1248 at expiration. So we were still on the right side of the trade, even though the stock went 15% against us. That is the power of using this of using this option wheel strategy, taking advantage of that increased inflated volatility, able to buy a stock at a major discount or get paid not to. Now let me show you the win-win. I guess we'd have to add another win to it. The win-win-win. Um, so if you get the stock put to you, you're long from 1240, then what do you do? Guess what? Because the stock has gone down, the volatility is very high, the balloon has been blown up with volatility. Now you could sell a covered call against it to lower your cost basis again. So now I sell the November covered call for 80 cents, sell the 13 call. That lowers my cost basis from 1240 minus the 80 cents I took in to 1160. All right, so now I'm long from 1160 and $13 is where I sold the covered call. So if I get taken away at 13, I make 12%. All right. And if it doesn't get taken away when that November option comes off the board, then I sell a December call to lower my cost basis again. Then sell it January, then sell it February, then sell it March. And continue to sell options till you either get taken away or you continually lower your basis. So it's a win-win situation because it's a stock you want to own. So again, a stock you want to own, only stocks that you can be into for a period of time that you're committed to, single dollar stocks, so you're paying for them full in front. If you get it put to you, Chesapeake's a great example. Sold a $6 call on a Chesapeake position. It's going to be a 40% winner if it's above $6 on this May expiration. If it's not, then I look to sell the June option against it and continually lower my cost basis. High volatility, lower price stocks. The idea, it's all about probability to generate revenue on a consistent basis. In addition to your other trading, this can fit your lifestyle. You do this on maybe 4 or 5 stocks a month. A little portfolio of this. In addition, generate premium, generate revenue. The whole process. Sell puts, get the stock, sell covered calls, get it taken away. Sell puts, get the stock, sell covered calls, get it taken away. That's it. Buy stocks at a discount. It's a great strategy. It's a win-win situation. Either you're getting paid or you're getting a stock you want at a lower level. So someone talk about Facebook. Now Facebook's hard because it's a $117 stock. But if you have the money and you've been waiting to get in Facebook, I had a lot of friends that have been waiting to get in Tesla for a long time. And I said, well, why don't you just sell a put on it? It's cash secure put because you have the money in your account. And they're like, well, I have this limit order waiting and waiting and waiting and waiting. So you can do that if you're committed to a big dollar stock. But this strategy is taking advantage of probability and small dollar stocks that have high relative volatility. Typically, the volatility is going to be greater than 75%, whereas the market itself, the VIX is at what, 16%. So you're finding a lot of these individual stocks, and there's a ton out there that have this extreme volatility. So the options are crazily inflated. And again, we're taking advantage of the novice traders that are buying those inflated options. We're a seller, but guess what? We're a win-win situation because we want them at a lower level. Think about Twitter. Twitter's volatility has decreased a little bit, but if you want to buy Twitter at a lower level, you can sell a 13 put in Twitter, okay? So what do you get for selling a 13 put? We'd have to look at it, but let's say you could get 40, 50 cents, your cost basis would be $12.50. Are you okay owning Twitter from $12.50, $1,250 tied up? Does Twitter have some upside value? Is someone going to come clean it up? Is there monetization there? They got all those users, but they are not, people aren't excited about how they're making money with it, so who knows? But some of these lower dollar stocks that have been beaten up, and think about all of the energy stocks, the coal, the natural gas, the copper, the aluminum, the commodity stocks, they just had such a major decline and then went straight up. So a lot of them are starting to come back down. So I'm going to start looking at a lot of new positioning. And I showed you Freeport McMoran, Seadrill is a $4 stock. There's a lot of these stocks that have this crazy inflated volatility, and your situation. Again, it comes back to discipline. Your risk, your reward, how much money is tied up, your probability, and your break even, so that you can make an informed decision whether that fits your style or not. So that's the strategy. What I want to show you right now is what my Bullseye Option 2.0 service offers, my Inner Circle membership, what you get. I showed you a little bit of my website. I give you 2 morning videos. It's what I do. I'm a commentator for CBOE TV. I do one on options early in the mornings called the Pre-Market Pulse. I also do the Morning Market Stir over at the CME group, where I set up the day based on what the futures are doing, a quick 2.5 minute morning setup for you, talking about what's moving. And obviously this morning, the movement was the euro currency making new relative highs and smashing the dollar index down, which was interesting in the fact that crude oil did not move up and gold did not move up on that. Typically, that's that should be, a positive with the weaker dollar. But didn't see that happen, and so the stock market opened up sharply lower and then continued to drift. It did recover during the course of the day, but then gave back some of the gains and try to fill in some of the gap. But anyways, so that's part of the membership. You're going to get the trade alerts. I showed you those comprehensive trade alerts. It's not just what to buy, but it's why, what sector, what stock, what option, what month, what probability, and what to risk. Everything is spelled out, all educational, so you can understand, where the motivation comes from the whole trade. Long, comprehensive, in detail reports for our trade alerts. Do about 1 or 2 of those a week. Again, these fit your lifestyle. They're longer term, not based on what happens in the next few hours, the next few days. I'm looking to see what happens in the next few weeks and months, and maybe even longer than that. So you're going to get your timely alerts. You're also going to get a nightly video, my where's my head at video, where I might take some of the clips I did on TV, some of the things that I was talking about, where I found of interest, maybe some unusual option activity, something that got my attention, something that I saw in the market, a specific level that I'm watching, a specific market that I'm watching, something that's that's got my attention. And then it's all about understanding that the Bullseye Option Inner Circle membership service is to put probability in your favor. Hopefully, you get some confidence in my optimism. There's always opportunity. There's always money to be made if you've got the skills to do so, and that's what this is all about. Is giving you those skills, using options to control probability, control time, to put the markets on your side. I'm not always going to be right. I'm going to be wrong, and if I'm wrong, I get my stop loss at half of what I pay. So if I'm wrong, I'm wrong. But it's all about probability. Think about this as a series of high probability events. So where are you going to be, in a week, in a month, in a quarter, in a year, in a decade? Think big picture. Go to bullseyeoption.com/TRY for my Inner Circle membership. You get 30 days. In my Inner Circle membership, and I was going to show you, it's $799 for those people that want to buy it for the year. It's $97 a month. If you buy a year subscription, that's going to give you 3 months free. It's $97 a month after the trial period. The trial period for $7, you're going to get 30 days of my Inner Circle membership. It's at bullseyeoption.com/TRY. There's nothing to lose by giving it a shot. Find out what I'm about. Find out if I can instill a attitude adjustment in you, and hopefully give you a little bit of energy to understand how important it is to control probability. I'll answer some questions now. And one of the questions I often answer, and that's where I come up with this slide, is about allocation. Here's an interesting slide that does a couple of things. It talks about the importance of risk control. Number one, if you're putting out a big position, and you're in the options market, you have limited risk. Number one, but what I want to talk about is the power of options to increase the returns. That's the idea there, is that even though there was only a 5 or 6% move in the underlying, this trader had a significant return, of 53% return in less than a month, because of the power of that in the money call option that I showed you. That's the payoff. That's the power of options. So this segues into answering the question here. The question is about allocation. I always tell people to start off with one contract at a time. All right, you can always become a bigger and better trader. Start with one, get comfortable with strategy, then you can become bigger and better. It's not how many contracts you trade. Really what it comes down to is slicing your account into 20 slices of pie. All right, so each and every trade has an equal weight and an equal value. So you're not gambling. It's not Texas Hold'em where you're putting it all in. It's about, if you divide your account into 20 slices of pie, each slice is 5%. So you've got 95% of your account left if that trade goes against you. And if you put in a stop loss at half of what you pay, you've really got 97.5% of your account left. Sign up for Bullseye Option, Inner Circle membership, $7, bullseyeoption.com/TRY. Someone asked a question here, do you consider earnings dates with high volatility? Yes and no. I'm aware of it, but a lot of times I'm going to take advantage of that increased volatility. A lot of times what you see is, as you go into earnings, volatility increases because there's an event. There's uncertainty of an event, and so that increases that volatility. So I'm going to maybe use that to sell, knowing my worst case scenario is buying X at X. If that's something that fits my criteria, that's great. I'm taking advantage of that increase in volatility. And then after the event happens, that volatility sometimes compresses, and that'll help us in the time decay process as well. So we're taking advantage of selling high volatility in this cash secured put strategy. And talking about volatility, I'll show you my trick in a second here of how to how to limit the impact of volatility in the options if you're an options buyer. If you're an options buyer. So that comes back down to the question here. And let me go back to, I answered the allocation question. Someone asked brokerage. It doesn't matter who you trade with. I use Trade Monster, which is now Option House, and Thinkorswim because they specialize in options. And that's important to me. You know, those platforms were built by options traders for options traders. So options are, again, just a vehicle. You have to use any platform that you're comfortable with, but it's just whatever's easier. You know, in saving a dollar here or a dollar there for commission is not that important. It's important that you're able to get the education and the assistance that you need when you need it. So remember that. That's very, very important. The question someone asked is, why do you go with the in the money options? In the in the money, it comes down to probability. So let me just show you here if I can go into sharing the screen again. So I can show you where people were completely right with picking the bottom in the market, okay? But they didn't have the right option, okay? So here, let me just show you another little trick as well. That what was interesting here, then silver, another indicator that the market was bottoming out and the sellers were getting tired, something I call bullish divergence. You could see that the market made new lows here at 1304, but volatility did not make new highs. So that was telling us that the sellers were getting exhausted, and that's sometimes a precursor to a bottom when you see that bullish divergence. So I use that as a signal a lot to kind of confirm what I'm looking at. But that silver play was absolutely textbook. Absolutely textbook. That saucer bottom, that cup and handle, and then when it broke out above this 15 level, the distance of this saucer, this $2 from 15 to 13, added up on that breakout, got to 17. Exited there. Absolutely textbook. Absolutely textbook. But what I wanted to show was SPX. If you look at the market in general, what happened was people that bought calls on this spike low here, all right, the volatility was extreme. All right, the volatility was extreme. Um, and so what happened was, even though they were right, as the market went up, volatility came out. The air came out of the balloon. So they were right on direction, but the volatility loss was greater, and a lot of those options ended up expiring worthless, even though people were 100% right on the direction. The way to rectify that is to buy those in the money calls. And if we go back to, let's just take a look at a recent trade. If you go back, if you look at an in the money call that has that high delta, let me see something that we had exited here. Coca-Cola. All right. Here's a Coca-Cola option position, made 50%, nice healthy trade in a period of 5 months. Okay. Coca-Cola had traded sideways, finally broke out. We had a call option when it broke out above 44, targeted 48, got a 50% profit. You know, Coca-Cola is not a high tech stock. All right. So that's an amazing return in a dinosaur. But we had the right option, the right strike price. So we had a January option, January 2017. We put this on back in February, right? February 10th. So we exited this here in March. So we still had 9 months of time. But if you can get a 50% return in a period of a couple of weeks, from a money management standpoint, put it in the bank. But what I want to show you here is buying an in-the-money option here. This option was trading at 550, I guess. Let's just say 575. The 38 call for 575. The market was trading at 42.60. So the break even was very, very reasonable. So it was $1 away. All right. So the break even was $1 away. So the break even was $1 away, and we had a year of time for good things to happen in Coca-Cola. But what's important here is if you look at it, that $1 is the component that's affected by time value. All right. So you're taking all of the time value out of the equation. All right. Because it was 475 in the money. So it had $1 of time value. So it was 475 in the money. So that $1 is impacted by volatility. So even if the volatility was double what it was in Coca-Cola, that option wouldn't be that much more expensive because only that tiny little component was impacted by volatility. So if you're going with the deep and only options, only the time value is impacted by volatility. The intrinsic value is not. So get something that has a lot of intrinsic value. That's the lesson to be learned. from that, and so that you can be successful on that. So someone asked a question about how do you trade Priceline today? Earnings tomorrow. Yeah, there are strategies to take advantage of each and every situation. I'd have to look at it, but a lot of times I'll play a earnings straddle where I'm buying both a put and a call because the markets can tell you, and we can look at Priceline. It'll tell you what the expected move is. The options market, if you look at the money straddle, will give you the expected move based on the options market. Could it be 7%, 9%, whatever, 5%? So that's what the market's pricing in. If there wasn't a greater move than that, then no matter what you buy, and it's not even telling you if it's going to be up or down, it's just telling you that it's going to be one direction or the other, that you're not going to make money. So what I look to do is I sometimes look for earnings to be a catalyst. So I might buy an earnings straddle for not for May because it only has another couple weeks. I might go out to July. So if I'm buying an earnings straddle, what I'll do is I'll buy both a put and a call, look for the breakout, if you're able to, get a reasonable put and call total premium based on the percentage of the underlying, and then look to see what happens after the earnings, after after the earnings, like we saw on Facebook. Facebook had a breakout earnings, so when it broke out, you have a call and a put. You drop the put, then you keep the call, and you still have 2 or 3 months for the call to continue to move, and that way you know what your break even is. So that's a little question on that. How quickly do they start to pay if you buy far out? What I'm doing is buying. If you the two separate scenarios, there's the option wheel where we're selling cash secured puts, taking advantage of time decay and high volatility, and then there's directional plays where I showed you Coca-Cola, silver. We had some great money in Pfizer. We had some great money in uh, what else? We're in J.P. Morgan. It broke out above 60. Not quite got to 65. Not quite. We're almost there. We got a profit order at 65, so we'll see if we can get another leg to the upside. But we still have July options in that, so we still have plenty of time. I don't have to make any decisions. I just have to manage the trade. Identify, execute, manage to maximize. That is the process. That is the process for each and every trade. That's what you want to have, is that discipline. Put probability on your side. All right, let me help you put probability on your side. Sign up bullseyeoption.com/TRY. Let me put this in the box here. I appreciate your time. I've got to go to softball practice, and we got to work on our pitching. Let me just send this off here so you can sign up and get all of this information. My Inner Circle membership, like I said, it's $799. If you pay for a year, that'll get you 3 months for free. Or it's $97 a month. You get a $7 free trial for 30 days. Find out what it's all about. Find out what I'm about. You're going to get a ton of content. This should fit your lifestyle. That's what this is designed to do. It's designed to take advantage of probability, time, and probability. That is the key. It should fit your lifestyle in addition to your active trading, in addition to whatever else you're doing. This is something that you can do to complement, to generate some premium, to be in some high probability positions. Bullseyeoption.com/TRY. That'll get you signed up. And let me just finish up right here with the bullseyeoption.com. You're getting the videos. You're getting the trade alerts, obviously, the comprehensive trade alerts that teach you, the strategy from beginning to end. Why that market, why that particular stock, why that strike, why that month, and why we're putting in that risk amount. So it's all spelled out for you. So that's a rundown. Let me just see if I have any more questions. Okay, I'd answer the brokerage question, the question about why the in the money, because it's all about probability. Think about it. It's just math. It's just math. I can look at any trade and go through my checklist here and decide whether it warrants my time or not. It's risk, reward, probability, break even. That's it. Risk reward probability break even. That's it. That spells it all out for you. That way, it's not my opinion. Now, I've got great instincts. I've been in the market for a long time. I've got great instincts about how I think the market's going to move. But when it comes down to it, this probability overrides everything. I only want to trade positions that have a 70% probability or greater. And these were the two strategies that I showed you today. So hopefully that you can imagine, you can visualize, and you can think to yourself, wouldn't it be great to not have to worry about the market, have confidence in probability? That's what it's all about. And if it doesn't come in, it doesn't come in. But you're putting odds on your side. And so you understand, the value in this methodology, in this approach. And like I said, I'm giving you an opportunity, $7, bullseye.com/TRY, $7 sign up. Now there will be, I do bi-weekly power sessions. So next week I'll do a power session for my customers where we talk about the positions we're in, where the market's been, where the market is, where the market's going. Talk about new opportunities. It's kind of a group coaching session where you get to ask questions as well about specific strategies, specific stocks, and I'm not there to tell you what to buy or sell. I'm there to point out the positives and the negatives and maybe different ways to look at it and different ways to play it. Take advantage of it. And again, it's very simple. It's not about opinion. All right. Anybody can have an opinion. Don't they say that? Opinions and but uh, anybody can have an opinion. It's about probability. All right, probability overrides all of my decisions. It's all either good odds or bad odds, and that's the way to live your life. That's the way. That's what you want to do is take advantage of high probability positions. Don't be that sucker. Don't be that novice trader that isn't putting probability on your side. That's what I'm all about. Someone asked if I alert. The alerts go by email. You're going to get an alert email. I had text for a while, but I was having some problems with it. I may implement that again. But what's most important is that if it's not something that you have to jump on right away. All right. If I see something, I'll say, okay, buy an option at $450 or better. Okay. The market might be trading at $400. I'm going to give you $50 of wiggle room because it's not important that you get in. It's not important that you get in immediately that second. People have jobs, people have lives, you got things going on. But it's important that you're getting in and you have that opportunity to get in for the next day or couple days or so, because it's not about what happens in the short term. It's about what happens in the next period of weeks and months. So don't feel like you're ever missing any. You're not missing anything by not being right on top of a trade. And it's going to give you plenty of time and opportunity to take advantage of the big picture. So that's what the email alerts look like. And you get those delivered to your email box, obviously. And there's also the website. You can just look at the website. You're going there hopefully to see the daily videos as well. And you can keep track of the trade alerts and go back and review. And what I recommend for a lot of people is obviously there's a number of positions we're in that not necessarily you weren't able to get into them at the time that we entered those trades. Like I said, we're very close to taking profits at JP Morgan. We've got a number of those cash secured positions. I sold those Freeport McMorans, cash secured puts and so forth for May. So just see how they develop. These markets are always going to be here. You're not missing anything. There's always more opportunity. And that's the lesson we learned here is about optimism. Be optimistic about opportunity and have fun with this. You know what's fun? Trading's not what's fun. Making money's fun. And there's a certain degree, like I said, a certain degree of fun in making money when other people are frustrated, when other people don't have the tools or the skills to make money and they just don't know what to do next. There's an amazing satisfaction when the markets were coming unglued, selling those cash secured puts, making those very, very healthy returns. So hopefully now you've got a little bit about the skills. Someone asked about how many trade alerts. Typically about 2 weeks, so it's not anything onerous. I'm looking big picture. I'm looking big picture. Like I said, this complements the active stuff you do. I'm not looking to be an active trader. Like I said, I've got softball to go to. I've got dance. I've got soccer. I've got soccer practice. I got soccer. I've got softball practice. I got a lot of things to do. Summer's coming up. I want to spend a lot of time with my daughter. And that's what this does. This allows me to make the markets work for me, not me work for the markets. It fits my lifestyle. Now, I know a lot of you folks are active with your active stock trading, but a lot of folks don't have the opportunity to do that every day. There's other commitments in your life, and that's what you want to enjoy. You don't want to be chained to your computer. And we've all done that. You can't get up, you can't go to the bathroom, you can't go have lunch. You can't enjoy yourself. You are chained to your computer. You want to get away from that. You want to get into the discipline of letting the markets do their thing, but still being able to take advantage of it. So that's the rundown, bullseyeoption.com/TRY. Let me put it in the travel box here again one more time. And I am off to softball practice, bullseyeoption.com/TRY. I look forward to seeing everybody in the power session, the bi-weekly power session that I have, bullseyeoption.com. And we'll get to know each other better, and hopefully you'll have a whole new attitude adjustment about the markets working for you and making this enjoyable because you recognize how there's always opportunity. Turn that frown upside down, turn those lemons into lemonade, let of the markets. That's it. Thank you very much.